Okay, this video is specifically in regard to mortgages and what every home buyer needs to know, whether it's your first house, your second house, or your 50th house. And the reason is that mortgages and financing and regulations change pretty often. So this is a real summary to bring you up to speed, even if you bought a house in the last few years. So first of all, mortgages are heavily influenced by two things: credit score and debt to income ratios. Your credit score is basically your history of making payments on debt. So sometimes having no credit is just as bad as having bad credit, because a lender doesn't know what kind of risk you are. Oftentimes lenders will go to a client and say, hey, we need you to open a credit card, get the utilities in your name, and do some other things in order to establish credit, because no credit nowadays, unfortunately, is the same as bad credit. And one thing that a lot of people don't understand is that these credit reporting companies like Equifax or TransUnion, what they do is they simply report the credit. They do not necessarily interpret it or provide numbers. Now, a car dealer, a mortgage company, and insurance company, all three of these companies, all three of these industries will have a little bit different ways that they view, different models that they use to interpret that information. So you might have a 700 credit score with your insurance company, or a 715 when you go to get insurance, or when you go to buy a house, because what they're doing is they're interpreting that information using different models, and it took me a while to understand that. Debt to income ratio is just the money you have coming in versus the money you have going out. The income part's easy, but the debt is specifically any debt that would show up on a credit report. So what we're looking at is two types. One is revolving credit, such as a line of credit. I've got a home equity line on my house that I'll use, so it goes up, it goes down, it can be zero. A credit card is revolving, it can be all over the place. And then there's fixed lines, such as a car, child support, mortgages. Those are what you have going out. So typically, like your cell phones, I don't think certainly your utilities, they're not necessarily reporting to the credit bureaus, so those aren't going to show up, and those aren't counted with your debt to income ratios. Also, the third piece of the pie, which is a little less important but still big enough to kill the deal, are your assets. A lot of mortgage companies, they want to know where your down payment's coming from. Sometimes parents will give their kids, or family members will give family members gifts for their down payment. Well, if that's the case, the mortgage companies know where that money came from. There need to be gift letters, there needs to be documentation, so it doesn't look like the borrower went out and got a side loan for their down payment. Also, reserves. Most lenders want to see 1 to 3 months of reserves, and what that means is they want to see you have cash in the bank in order to pay for 1 to 3 months of your mortgage payment. So if you're scrapping together all your money for the down payment and left with a very low nest egg, it can bite you right here, and you could be great here, and great here. But if your reserves aren't adequate, it can kill the deal. So knowing this information is good to kind of have in the back of your mind, but of course, meeting with a lender, a local lender, and getting a written pre-approval makes all the difference in the world. Hope you find this helpful. Feel free to forward it to somebody that's thinking about making a move. And remember that I'm never too busy for referrals. Thanks.